Most people think the destruction of their savings happened slowly. Inflation here, a bad decade there, something gradual, almost accidental. But that's not true. The real damage didn't happen over 50 years. It happened in one single year, 1971. At the time, it didn't feel dramatic. There were no empty shelves, no financial panic in the streets, no headlines warning that personal savings were about to enter a permanent decline. Life looked normal. People went to work. They deposited paychecks. They trusted banks. They saved money for the future, believing it would still mean something years later. What changed in 1971 wasn't visible. It was structural. And once it changed, it never changed back. Before that year, money was anchored to something real, not perfect, not fair, but limited. After 1971, that anchor was removed, quietly, legally, and permanently. From that moment on, saving money stopped being a safe act. It became a losing strategy. Not overnight, but inevitably. In the early 1970s, an average household could still believe that patience was rewarded, that working, saving, and waiting would protect their future. But the system was already moving in the opposite direction. 1971 marked a moment when money stopped being restrained by reality and became restrained only by policy. And policies change, often suddenly, often without warning. Once that door was opened, there was no technical way to close it again, because after 1971, money could be created without a natural limit. And when money has no limit, its value always moves in one direction, down. At first, the decline was subtle, barely noticeable year to year. But over decades, it became brutal. Wages struggled to keep up. Savings lost purchasing power, even while sitting safely in the bank. Doing nothing became expensive. The cruel part is that the system still looks familiar. The numbers still go up. Accounts still grow. Balances still look bigger. But the meaning behind those numbers has changed. $1 after 1971 is not the same promise it was before. And the system never explained that difference clearly. People were taught to blame themselves instead, for not investing early enough, for not saving aggressively enough, for not making better choices. But the game itself had already been altered. 1971 wasn't a market crash. It wasn't a recession. It wasn't a temporary crisis. It was a permanent shift in how money works. And once you understand what changed that year, you start to see modern financial stress very differently. Because what feels like personal failure today is often just a long shadow of a decision made decades ago. And that shadow still shapes every dollar you save. After 1971, the damage didn't announce itself. It blended into daily life. People kept doing what had always worked. They saved more. They waited longer. They trusted the math. And for a while, the illusion held. Balances grew. Interest appeared. Statements looked reassuring. But something invisible was happening underneath. Every year, the same effort bought slightly less. Every decade, the gap widened, not enough to shock, enough to exhaust. The system didn't collapse. It slowly leaned against those who followed the rules. Saving stopped being protection and quietly became exposure. Because once money could be created freely, time stopped working in favor of the saver. Time started working against them. Inflation wasn't just rising prices. It was a constant tax on patience. The longer you waited, the more value slipped away. This created a strange psychological tension. People felt responsible for outcomes they couldn't control. They worked harder but felt poorer. They saved more but trusted less. And when frustration built up, the blame never pointed upward. It turned inward. Maybe I should have started earlier. Maybe I didn't choose the right job. Maybe I wasn't disciplined enough. But discipline doesn't defeat dilution. After 1971, money wasn't designed to hold value over long periods. It was designed to circulate, to move, to be spent, borrowed, leveraged, or invested. Standing still became the worst position. That's why financial stress today feels constant, even during good times. The pressure never releases. There's no finish line where saving feels complete, no moment where safety feels permanent, because the system no longer rewards stability. It rewards motion. This is why risk became normalized, why volatility became acceptable, why ordinary people were pushed toward markets they didn't fully understand. Not because they were reckless, because they were trying to survive erosion. Saving alone could no longer defend the future. And yet, the cultural language never updated. People were still told to be patient, still told to trust the system, still told that time would fix everything. But time had already been turned into an enemy. What's unsettling is how normal this now feels. Rising costs, permanent uncertainty, the sense that no amount is ever enough. That feeling didn't come from nowhere. It came from a world where money stopped being scarce by design. Once scarcity disappears at the top, it reappears everywhere else, not through sudden collapse, but through constant pressure, a pressure that reshapes behavior, changes priorities, and quietly rewires how people think about the future. By the time most noticed, adapting wasn't optional anymore. It was survival. And the hardest part isn't that the rules changed. It's that they changed without telling anyone, that the old ones no longer applied. As the years passed, the pressure didn't explode. It normalized. A new financial reality settled in, one where instability felt ordinary and long-term certainty felt unrealistic. People adjusted without fully realizing they were adjusting. They delayed plans. They lowered expectations. They redefined what doing well even meant. Owning a home stopped being a milestone and became a lifetime commitment to debt. Retirement stopped being a destination and became a moving target. Saving stopped representing freedom and started representing anxiety, not because people became irresponsible, but because the ground beneath them kept shifting. After 1971, the system didn't need people to understand it. It only needed them to participate. Money flowed faster. Debt expanded quietly. Asset prices climbed in ways wages never could. And this created a widening psychological gap. Those closest to newly created money felt protected. Those farthest from it felt squeezed. The difference wasn't intelligence or effort. It was position. By the time money reached the average saver, its value had already been diluted. What looked like growth was often just compensation for loss. This is why modern financial life feels like running on a treadmill. Movement without progress. Effort without relief. You can do everything right and still feel behind. And when this becomes a norm, behavior changes. People stop trusting long-term promises. They favor speed over stability. They trade patience for urgency. Short-term thinking isn't a moral failure. It's a rational response to a system that punishes waiting. This is where discomfort deepens. Because once everyone is forced to move faster, the system itself becomes more fragile. Risk builds quietly. Debt stacks invisibly. Confidence replaces security. And yet, from the outside, everything still looks functional. Markets rise. Technology advances. Numbers get bigger. But beneath that surface, financial life becomes thinner, more sensitive, more reactive. Small shocks create outsized stress. Minor disruptions ripple outward. The margin for error shrinks. That's why financial anxiety today doesn't require a crisis. It exists even during growth. People sense that something is off, even when they can't point to a single cause. They feel one bad decision away from instability, one interruption away from setback. That feeling didn't emerge naturally. It was engineered by a system that removed long-term anchors and replaced them with perpetual motion. Once stability disappears, people internalize uncertainty. They carry it into work, into relationships, into daily decisions. Financial stress stops being situational and becomes ambient, always present, always humming in the background. And when a system produces constant pressure, also produces conformity. Few question the structure itself. Most focus on coping within it. They adapt, they comply, they optimize, not because they agree, but because resistance feels impractical. Over time, this quiet pressure reshapes expectations. What once felt unacceptable starts to feel normal. What once felt temporary starts to feel permanent. And the longer this environment persists, the harder it becomes to imagine that things could have worked differently. But they did. And understanding that difference is the first step towards seeing the present clearly. Instead of blaming yourself for responding logically to a broken incentive system. As pressure became normal, the system offered something in return. Options, not real freedom. The appearance of control. More accounts, more products, more strategies. The message was subtle but consistent. If you felt behind, it wasn't structural. It was strategic. Choose better. Optimize more. Take smarter risks. This reframed the systemic problem into a personal responsibility. And people responded exactly as expected. They learned new rules. They chased higher returns. They accepted volatility as the cost of staying afloat. What once felt dangerous slowly became standard. Debt was no longer a warning sign. It became a tool. Leverage was no longer exceptional. It became normal. Risk stopped being something to manage and became something to rely on. This wasn't reckless behavior. It was adaptive behavior. When stability disappears, exposure feels like the only alternative. But here's where the illusion deepens. Most choices offered after 1971 exist inside the same framework. Different paths, same destination. You can save aggressively. You can invest cautiously. You can chase growth. But all of it happens inside a system where the unit of measurement itself is unstable. That's like running faster on a floor that keeps tilting. The effort increases. The control feels real. But the outcome remains fragile. This is why modern financial advice often feels exhausting instead of reassuring. There's always something else to adjust, another rule to learn, another risk to accept. And if it doesn't work, the failure feels personal. That's the psychological cost. When systems stop providing stability, they compensate with complexity. Complexity creates the impression of choice. Choice creates the impression of control. But control without a stable foundation is just motion. Over time, people internalize this dynamic. They stop asking whether the game is fair. They focus on how to play it better. They compare themselves to others instead of questioning the structure. They measure success relatively, not absolutely. Doing okay becomes a goal. Staying afloat becomes success. And slowly, expectations compress. What previous generations considered basic security starts to feel ambitious. What once felt temporary feels permanent. This is how systems endure without open resistance, not by force, but by adaptation. The discomfort never disappears. It just becomes familiar. People learn to live with it, to plan around it, to explain it to themselves. They tell stories about cycles, about personal growth, about resilience, all of which sound reasonable, until you notice the common thread. The future always requires more effort for less certainty. That trade-off didn't emerge naturally. It was introduced. Once money lost its anchor, everything tied to money became conditional. Security, planning, patience. Nothing fully disappears. It just becomes harder to reach. And when a system makes security feel distant, people stop expecting it. They stop demanding it. They adapt instead, which is why the most powerful effect of 1971 wasn't economic. It was psychological. It taught an entire society to live with permanent uncertainty and call it normal. Once uncertainty becomes normal, something deeper changes. People stop planning in decades and start planning in fragments. 5 years feels ambitious. 10 feels unrealistic. Someday, quietly disappears from the vocabulary. This isn't because people lack discipline or vision. It's because the system trained them not to trust distance. After 1971, the future stopped feeling solid. It started feeling conditional. Everything became dependent on variables outside personal control. Policy, rates, markets, decisions made far away by people never affected by the consequences. So behavior adapted. Security turned into flexibility. Ownership turned into access. Commitment turned into optionality. On the surface, this looks like progress, more freedom, more mobility, more choice. But underneath, it reflects something else. When anchors disappear, people stop attaching themselves to long-term promises. They keep their options open because they don't believe the system will keep its promises either. This is why modern life feels temporary, even when it's expensive. Why stability feels fragile, even when everything is working. The cost of living isn't just financial, it's psychological. Constant adjustment requires constant attention, and constant attention is exhausting. The mind never fully rests. It's always calculating, hedging, preparing, not for opportunity, but for disruption. That background tension didn't exist before money lost its anchor. When value was stable, patience made sense. When value became fluid, patience became risky. This is a quiet legacy of 1971. Not inflation alone, not debt alone, but a permanent shift in how people relate to time. The future stopped being something you moved toward. It became something you managed defensively. And when an entire society starts thinking this way, the effects compound. Less trust, shorter horizons, more stress disguised as ambition. What's uncomfortable is realizing how logical this all is. People didn't fail to adapt. They adapted perfectly to the incentives in front of them. The failure wasn't individual. It was structural. Once you see that, a strange clarity appears. You stop blaming yourself for outcomes that were never fully in your control. You stop measuring success by rules designed for a different monetary reality. And you start asking better questions. Not, how can I save harder? But what does saving even mean in this system? Not, why does this feel harder than it should? But who benefits from it feeling this way? 1971 didn't destroy savings overnight. It changed the environment in which savings exist. An environment shaped behavior more than intentions ever could. Understanding that doesn't solve everything, but it does something important. It removes the illusion that the discomfort is personal. It places it where it belongs. On the structure, if this perspective helped you see modern money differently, and you want to keep unpacking how these systems quietly shape everyday life, you can stay connected here. Not for quick answers, but for clearer questions. Because once you understand when the anchor was cut, you stop wondering why everything feels harder than it should.